Hello, everyone. My name is Ron Bullis, and I'm the founder and CEO of LifeWorks Advisors. When I started my day-to-day, I didn't intend to make a video on some of the things that have gone on in the stock market and the economic headlines, the news of the day. However, after getting up, doing my workout, my devotions, having breakfast with my family, I popped open the old iPhone, started scrolling the news before I headed to the office around 7:30, saw that the futures markets were down significantly. And everywhere I looked online was doom and gloom. Trump tariffs, the US going into recession, global trade wars, the market's gonna implode, et cetera, et cetera, et cetera. So I thought it would be wise to just take a couple minutes. This is gonna be a short video, not as long as our normal client market updates are, but just address some of the things I covered in February about tariffs, the market, how LifeWorks is positioning our clients in today's environment. And there's be a helpful grounding, let's say, to all of the headlines that are coming out right now and that we're likely to see over the next, I don't even know, days, weeks, months, for as long as this narrative kind of persists. So I'm going to jump in. I've got a quick slide presentation. I want to cover some things that I talked about in February. So it'll be a little bit of rehashing if you watch the February client market update. But I think it's important to ground at what are tariffs, how do they work, who really pays for them. Then I'm going to talk about market forecasting, economists. Everywhere that I went when I was online today, right, from CNBC to CNN to Fox, just read everywhere doom and gloom. What are we to make of that? Should we be changing our investment strategies or our approach to how we're managing money, how we are navigating our clients' financial plans, how you should be thinking about retirement or investing for the future based on what's going on today? I received emails today from advisors who were getting questions from clients about, hey, we're thinking about buying a car. We were going to put it off for a couple of years. Now that the tariffs are here, should we go out and buy one today? Are the price of cars going to change, et cetera? So I'm going to talk a little bit about how we at LifeWorks think about what's going on in the market today, how we're positioning assets, and how we're helping you make the best decision for your family going forward. All right, so let's jump in. As I said, I have a quick deck here. And let's cover something that I talked about in February just really quickly. I want to level set this. Who really pays for a tariff, right? So a tariff is essentially a tax that is paid by an individual or a business that's importing a good or service from, generally goods, from another country, okay? Now, what Trump announced today was a long list of reciprocal tariffs. I think most of us, including myself, really never paid attention to until just recently, is how many other countries in the world actually put tariffs on US exports, meaning goods that we manufacture in the US that we would export into their economic zones like the EU or their individual countries. Now, this is not meant to be a political conversation. I personally think tariffs are bad for all economies and all of humankind. There's plenty of Nobel laureate economists out there, Hayek, Bastiat, Ludwig von Mises, that I think have done a compelling job dispelling the myth that a tariff actually is a good thing. So let's not cover that. Let's just talk about who's really going to pay for it. And I think the simple truth of this, and there was a recent white paper, research paper that was written 2021, something like that, that showed that on average, the US citizen picks up about 90 to 95% of the cost of tariffs. So what does that mean today? I think what that means for us today is that there could be inflationary headwinds still ahead of us. If the price of goods and services go up because of these tariffs, I think it's logical to assume that in some areas of the economy where the importer or the manufacturer of a good can't absorb that cost, they're probably going to pass it on to us, the consumer. If you've heard any of my market update videos before or watched any of my videos on YouTube, you know that I will say, and I'm going to cover this at the end of our presentation, that the real risk we face, both the age group that I'm in my mid-40s with kids at home, accumulating, saving for retirement, and those of you that are potentially retired or about to retire, the real risk that we face is not market volatility. It's that everything we need to live on is going to cost us more every year for the rest of our life. It's inflation. So when I see news headlines or government policies that are driving inflation, I'm always going to call a spade. I think it's a bad thing to enact tariffs, even if there's potentially some geopolitical, national security. There's probably a lot of reasonable arguments for why tariffs are being used as a negotiation tool. In February, when I talked about this, I had a lot of really great feedback and questions and stuff like that, where you guys were pointing out, hey, I've heard Trump's using tariffs for this, or this is maybe what they're doing. And those are all potentially valid arguments. I'm not arguing that here right now. But if the tariffs stick, just know that it's going to be the US citizen who's going to pay for that increase. That is an inflationary event, which means the value of our dollar is going down. Now, government spending, and our government is out of control with spending. Practically every administration since I have been a financial advisor, which is pushing 20 years now, has recklessly spent and drove our federal debts through the roof. Government spending is probably the #1 cause of inflation, but back to tariffs. Okay, so let's just talk about what tariffs actually do, right? Outside of the arguments around using tariffs from a negotiation perspective, which I think is probably likely one of the things that's happening right now, right? It's a bargaining chip. But what tariffs actually do is they disrupt the free markets. Now, you might say, Ron, we don't have a free market. I would agree with you. There's lots of regulation. There's lots of things that would be valid arguments for why our market truly isn't free, but this is just adding to the lack of free markets. When we disrupt the free markets, what we do is we alter, right, the price of goods and services. So now something that we were importing from Canada, say lumber for our housing market, right, or potash, which is used in lots and lots of different things, is now going to cost more, right? The argument then is maybe we would produce that, or we would harvest our forests here, or we produce potash, or whatever the item is here in the States. Some of those things we might be able to do, but other things, there's natural resource constraints. There's time that it would take to build a manufacturing plant. There's the knowledge, expertise, intellectual property maybe to produce something. So what happens now is it's going to distort the prices. Somebody might say the US-based version of that, or the US manufactured version of that, it costs more, but now it costs the same thing. I was explaining this to my kids over breakfast this morning. It still costs the same thing, right? We're still now paying more for it, where we could have paid $100 for a good that we were importing, and now we're paying $150. If we bought the US manufactured version of that paying $150, that doesn't actually add to the wealth in our economy. It just displaces it from the consumer's wallet book to potentially a US-based manufacturer. It just moves it. So it distorts also this economic calculation, how resources are allocated, winners and losers are picked. So I'll mention one more thing about tariffs, and then I'll move on here. Tariff policies don't just change prices, they fundamentally distort the economy's ability to self-coordinate. When entrepreneurs can't accurately calculate which ventures will be truly profitable based on genuine consumer demand and resources available, the entire economy becomes less efficient and less responsive to actual needs. So if I pause there a second, and we'll just cap tariffs, because I didn't want this entire presentation to be about tariffs, but everywhere we turn and look, this is going to be the headline, and the dominant narrative is Trump tariffs, Trump tariffs, Trump tariffs. Again, this is not political, this is just the reality. Tariffs, I think, in the short run, are going to have negative impacts, or potentially could have negative impacts from an inflationary standpoint. In the long run, they're going to disrupt the free markets. Those are not good things for you and I as the consumer. Now, I'm going to be talking about this in a second. I'm not prognosticating or forecasting where the economy is going to be. I'm not trying to forecast whether this is going to be a net positive for the market or where the winners and losers are going to be. But I just wanted to cover the fact that tariffs may be being well intended by the current administration if they are not rolled back, or if they are not altered or changed or removed, will have negative consequences for us as US consumers, and I don't think that is good in the long run. Okay, so I get questions right now. I fielded a bunch of them today and over the last couple of weeks, both from clients and our advisors, about how the underlying US economy is doing. So one measure that I think is worthwhile to spend just a couple of minutes on here is to look at this and say, okay, what's going on with unemployment? Now, right now, and I'm just going to cover this quickly, the unemployment rate, this is a broad measure of unemployment here. It's the U3 measure. Took this right from the Federal Reserve FRED database. As of February, so they generally are about a month behind in reporting, the unemployment rate in the United States was about 4.1%. Now, that's across everybody 16 and up. That's of working age. That's a participant in the labor force. If we actually stratify that by education level, people with a bachelor's degree of education and higher, their unemployment rate is in the low 2%. People with a high school diploma and some college, their unemployment rate is in the 3s. So when we look at the unemployment rate, the underlying US economy in terms of there still being lots of jobs available for workers is quite strong. So while the US consumer has seen their wages be fairly stagnant over time, unfortunately because of inflation, and while they've increased the amount of their consumer debt liabilities, I covered that in February, the reality is that the unemployment rate is still quite strong. Interest rates, which I'm not going to cover today, are still relatively low historically speaking. And the profits for most of our US-based companies, right, if we look at the S&P 500, the profitability of most companies is actually still quite strong. Okay. So why am I setting all this up? What you're going to be bombarded with, what I'm going to be bombarded with, is going to be news headlines touting the doom and gloom that's ahead of us. In fact, I looked at one right before I clicked record here, and it was just red all over the page, big bold letters, right? Worst day in the market since 2020. Trump's tariffs are just, you're seeing them. So what I wanted to stop and pause was this. When our fear or our emotions as humans starts to kick in, nobody likes to lose. In fact, it's known in the advertising and marketing circles that if you use fear in your advertising and marketing, you're more likely to get people to make a decision or to take action because we are more likely to try and avoid pain or loss than we are to go for gain. So knowing that is a psychological truth about all of us as humans, right? We need to try and unwind that hardwired instinct. We need to build systems in place, and I'll show how we're doing that at LifeWorks, to make sure that when the rest of the market is fearful, and when the advertising agencies, online news sites, pundits, talking heads are winning because they are selling millions and millions of clicks on headlines that are very fearful and very enticing. I would almost call it fear porn. We need to understand the historical context of it and check whether we should actually be taking action on it. So I thought this would be helpful. I've tracked this for a long time. I grabbed a couple of resources here. If you do a quick Google search, you can confirm this. But if we say, what's the success or probability that an individual or a group of individuals is somehow able to forecast what's going to happen in the US markets and the economy? Here's what we get. Stock market experts have about a 47% accuracy rating, which is actually worse than random chance. Meaning all the talking heads that you're going to see about how Trump tariffs are going to be negative, or Trump tariffs are going to be positive, or interest rates are going down, or interest rates are going, all of those forecasters have essentially the same probability of being right as flipping a coin. Now, know this, they still get paid when we click on their articles, when we watch their shows, when we get sucked into this charlatanesque way of approaching the US markets and the economy by predicting what's going to happen. Now, Wall Street economists correctly predict interest rate direction just 35% of the time. So 1 in 3, even worse than random chance. And another one here, the last one, 48% of professional market forecasts are accurate, only 48%. And that looked at an analysis of about 6,000 predictions or forecasts. So the takeaway here, is that every talking head, every article you're going to see, every fear, doom, gloom, if you don't take action now, you're going to lose, et cetera, is likely to be wrong. Now the question is, Do we want to leave our financial futures to that type of a flip of a coin and probability? And the answer should be no. So here's a truth that we base our investment strategy and how we do financial planning for our clients here at LifeWorks. And this is not, all of you watching this are clients of LifeWorks more than likely, so this is not a sales pitch for LifeWorks. This is a reminder of the philosophies and methodologies that are the foundation for how we do what we do and why we believe it is the right approach. Here's the truth. No one at LifeWorks, no one on Wall Street, no one with a crystal ball somewhere can actually predict what's going to happen in the market, which means you can't time it. So anybody right now, the Jim Cramers of the world saying, go to this asset class or buy this or sell this, or here's going to be the winners and losers from the Trump tariffs, like they're likely to be wrong. You can't time the market. You can't forecast the economy with any degree of accuracy, but you can time your cash flows. You can time how long you work. You can time when you take distributions. Now, to a certain extent, those of you that are retired, we have fixed living expenses. I know we have to take out of the portfolio to cover your living expenses, but for the most part, we can time those things. And so what we can do is we can look at when you need to spend the money. Now, if you're in my age group again, you're an old millennial and you're still accumulating towards retirement, we can look at when do we need to spend these dollars? Am I worried about what happens in the market today? Yes. Am I worried about how that's going to impact my investment accounts today? No, because I'm not going to be spending those dollars for 10 plus years into the future. And history, at least the last 100 plus years of history of the US economy and the US markets, has shown us that the markets will have ups and downs. There will be bear markets and corrections. There will be recessions. But over time, the market has moved forward and returned positive rates of return on a long-term basis. Now, in the short term, there is lots of periods of history where the market's been negative. So if you're in my age group and we're still accumulating for retirement, am I worried about the economy? Am I worried about what's happening in the market? Yes. Should I change my investment strategy or philosophy based on tariffs on, tariffs off, or something like that? Absolutely not. Our investment philosophy and our investment strategy, should be based on when do we need to spend the money. If you're in retirement, it's even more nerve-wracking. Markets going down. Are you going to have enough money? Is this going to impact how you wanted to live in retirement, your dreams, the things you want to do for your kids and your grandkids? I understand it. In fact, it's one of the most important things that I spend a lot of time talking with our clients, teaching our advisors, right? How do we navigate this part of the emotional side of being long-term investors when the reality is we're only long-term investors because we are trying to afford to live the life we want. We're trying to exercise our values and vision, and the money is the resources that help us do that, right? So when you're in retirement, this is even more worrisome, right? But this is a simple picture here of how we help our clients think about allocating their assets in the market. In fact, this is the fundamental way that we do it. We look at when you need to spend the money. So if you need to spend money next year for your living expenses, those things should be sitting in short-term treasuries, cash, things with a very little volatility. Now, those things generally have less return. If it's money that you don't need to spend for 10 plus years into the future, then those things should be invested in growth type of assets, stocks, gold, Bitcoin, real estate, etc. All of those things, all of the 10 plus year dollars are going to be on this roller coaster. And I don't know what the next couple of days, weeks, or months are going to hold for us. We could be going into a significant bear market. I don't know. We could be just going to have a period of a short-term kind of market correction and then bounce and continue to head up. I don't know. But I do know that history has shown us that the US equity markets are the best wealth creation tool and hedge against inflation in the long run. And every dollar that we don't need to spend for 10 plus years in the future should be focused on growth. So we're not making changes based off of our fear, based off of somebody telling us what's going to happen in the market, based on some smart person telling us that because tariffs are here, it's going to impact this industry and we should get out of that and we should move to cash. Ignore all of that. Let's just take a quick look at a few more things here as I'm wrapping up, which I think are helpful. When we think about timing cash flows, the reason at LifeWorks we target having 3 years of your income needs in safer assets. again, treasuries, cash, things like that. And then we have 4 to 7 years of your spending needs in low volatility things. So bonds, hedged equities, things like this. And then all the money for 10 plus years in the future is in growth, is because we can look back at history and we can learn from it. Now, history isn't going to perfectly repeat itself in the future, but it's certainly going to rhyme. It's going to be very close, and we should pay attention to it. So here is a quick chart showing you the business cycles or recessions that we've had in the US since 1854. And this is stats compiled by the National Bureau of Economic Research. And there are some definitions of a recession that say if you have 2 or more consecutive quarters of negative GDP, that's a recession. That's not how the National Bureau of Economic Research does it. They define it as 2 consecutive quarters of decline in economic activity spread across the economy. So the takeaway here, though, what I want you guys to see is that from 1945 to 2020, right there on the bottom left-hand corner, from the peak of an economic cycle to the trough, the bottom, is about a year. It's about 10 months. When we go from the trough to the peak, the climbing back out of the recession, it's about 5 years. It's about 60 months on average. So there is a reason for us to hold 3 years of safer assets. It's to give us the ability to weather recessions that are going to happen. Now, if we put next to recessions bear markets, a bear market being defined as a decline of 20% or more. There's a lot of numbers here, and I apologize, the screens may be a little hard to see. Here's your takeaway. In the last 120 years, there's been about 19 significant bear markets where it's declined by 20% or more. Now, the average duration of a bear market, right, is actually quite short. And what we're looking at here is how long it takes to recover from a bear market adjusted for inflation. So the lost decade, which would have been the 2000 through 2013. So we've got the dot-com bubble, the tech bubble at the beginning of the 2000s, and then had some recovery, and then wham, the great financial crisis. It would have taken almost 13 years to recover, adjusted for inflation. The 1970s would have been another really difficult period. It would have taken almost 11 years to recover in that space. And then obviously the Great Depression is number 1. Why do I show this? 1, because I want to say we shouldn't just blindly invest our money, right? Again, we should invest our money and follow a strategy so that we're owning the appropriate type of asset for when we need to spend it. But we also need to remind ourselves that bear markets and recessions happen. There are some people that believe in cycles, that the economy and the US markets move in cycles. I think there's some good evidence that also shows that's not a good predictor, but certainly we should expect that what goes up is going to come down. And we are going to have kind of this rolling hill where we climb up a little bit and then we fall down a little bit and then we climb up again and we fall. And these things are normal. Now, the facts about bear markets, there's been 19 of them, right? Average duration of a bear market's about 51 months. And that's from peak to peak, right? From the high point through the low point back to recovery. And the average decline in a bear market is about 34.6%. That's a really big number. Put that in context today, where we sit right now, okay? We're something like 12% or maybe a little more than 12% down in the S&P 500 year to date, right? So to hit bear market territory, the average of bear markets in the US, we actually have a long way to go yet. I hope we don't get there, but if we do, it's not to say that it's unprecedented. It's not to say that the US economy is going to end or that your account's going to become worthless. The message here is that LifeWorks has your investments allocated correctly based on when you need to spend the money. Okay? A couple more things that I think are important when we're looking at this. The reason why we follow an investment methodology that selects the right type of assets for when you need to spend the money, not some kind of risk tolerance questionnaire or not some kind of prognostication of where we think the market's going to perform best. The reason for that is that we're also very aware of something called sequence risk. So for those of you that are in retirement or nearing retirement, check in here. This one's important, right? So if we retired in 1980, this is just an example. This is using the S&P 500 total return, by the way. If we retired in 1980 with $1.5 million in our retirement account, and we wanted to start by taking a 4% distribution, a $60,000 distribution, and then we adjusted that distribution every year for inflation, by the time we get to the end of 1999, 20 years into our retirement, we'd actually have 23 million bucks. Now, I want you to hold that number in your head, and I want you to contrast that with if we retired in 2000. I'll save you the spreadsheet here because I know we're running short on time, but if we had the same $1.5 million in our retirement account and we retired in, if we retired in 1990, and then we followed that through for 20 years, we'd have $500,000 in our account. So what this highlights here, what this underscores, is the importance of making sure that as we're going into retirement, as we're going into a period of time when we're going to be pulling money out of our investment accounts, that we're not doing it in a way that we're going to be pulling money out of the market when the market's down, which is why we hold 3 years of safer assets, cash, short-term treasuries, money market accounts, CDs, so that we give ourselves the time to weather recessions, to weather bear markets, and to intelligently be able to take distributions of the portfolio and not, or let's say, minimize the impact of sequence risk. One more here, and then we're going to wrap up. I hope you found this informative. I just wanted to do a quick chart to give some perspective. This was as yesterday's close, so the lines on the far right here are going to be a little sharper falling off. The bright blue line is the NASDAQ. The dark kind of blackish blue line in the middle there is the S&P 500. And this is the last 20 years of returns. I just set them all. I indexed them to 0 20 years ago. And I said, where are we at today? What do these graphs look like? How have the markets actually performed? And what we can see is that technology, the NASDAQ's way outperformed the S&P 500. The S&P 500 has outperformed international. And it's also quite significantly outperformed small cap, the Russell 2000. Now, why do I say all that? Because remember I said that investing will feel like we're on this rolling hill where we climb, we have positive returns, and then we're going to go down the hill, but we're not going to go all the way back to 0 if we're invested correctly. And then it's going to bottom, and we're going to climb back up again. So that's likely what we're going to see here, right? Whether this negative run that we're on today continues for the next days, weeks, months, I don't know. It's going to go down, and then it's going to hit a bottom, and it's going to climb back up. That's what history has showed us time and time again. So what we need to keep our focus on is, one, turn off all of the forecasters, the pundits, the people who are predicting where the market's going to go or how the Trump tariffs are going to impact different sectors or whatever the forecast is. Interest rates are going to go down, etc. Just know that all of those forecasters and all those people selling headlines and selling investment advice have the same probability of being right as randomly flipping a coin. We can't time the market, but we can time our cash flows, which means as long as we're allocating our investments in the market according to when we need to spend the money, we are going to minimize the risks that A, we fall prey to market timing, which is a disastrous investment approach. B, we fall prey to just blindly following the herd or trying to guess where we should be, or even worse yet, like pulling all of our money out of the market, maybe going and buying an insurance product because we just are afraid of losing it, right? Know this, over a long period of time, the US equity markets have been the best tool for building wealth and protecting our dollars against inflation that has ever existed. This current market might not be fun. Year to date, the S&P 500 is down 12%. Not a fun way to start the year. If we look back over the last year, though, the S&P 500 is still positive by about 3.5%. And if we roll back 5 years, 10 years, and 20 years, and we look at a graph like I had up there a minute ago, what we'll see is that there's still a significantly positive rate of return from our long-term equity investments. So I wanted to create this video, and it's probably a little longer than what I was intending. I hope you find it very useful. In the coming weeks, days, and months, try, and I fall guilty to this, prey to this, scrolling social media I'm on my phone. Just know you're going to see doom and gloom headlines. You're going to see people telling you, do this with your money, do that with your money, get into this sector, get into that sector. Interest is going to go down. Trump's a genius. Trump's a moron. Turn it all off. Know that how we are helping you invest your money here at LifeWorks by investing it based on when we need to spend it is the correct way. It is the right way to remove our emotions and fear, right, of avoiding pain and loss, and stay invested, because it is the only hope that we have of having our money outpace inflation over time so that we can live the life we want, that we can accomplish the financial goals and the family goals that we have, the vision that we have for how we want to live. So I hope you found this valuable. If you have any questions, don't hesitate to reach out to your financial advisor or anyone here at LifeWorks. Feel free to send me an email as well or a message if you have any questions on this, or if you want to talk any more about tariffs, the market, things like that that are going on. From everyone here at LifeWorks, I get to say this, and we truly mean it. We love serving you and your family, whether the market is doing really well or the market is taking it on the chin like it is today. Our goal is to build a durable and enduring investment strategy based on your family's financial plan. I know that we can achieve that together. I'm really proud of the work my team does, and I know we love hearing from you. We love talking to you. So God bless. Have a great rest of your week. And again, turn off the news headlines, and God bless.